Company stocks, also known as equities, represent ownership in a corporation. When a company goes public, it issues shares of stock that can be bought and sold on stock exchanges. Each share represents a portion of ownership in the company and gives the shareholder a claim on a portion of the company's assets and profits. Holding company stocks can provide an opportunity for long-term growth of wealth, as the value of the shares can increase if the company performs well and generates profits. However, investing in company stocks also carries the risk that the value of the shares may decrease if the company performs poorly. Owning company stocks gives individuals the opportunity to participate in the success of the company and benefit from its future growth potential. Stocks are often considered a key component of a diversified investment portfolio. There are several different types of company stocks, including common stock. This is the most common type of stock and represents ownership in a company. Common stockholders have a claim on a portion of the company's profits and assets, as well as the right to vote on important corporate matters. Preferred stock. Preferred stock is a type of stock that generally has a higher claim on a company's assets and earnings than common stock, but generally does not carry voting rights. Preferred stockholders may also receive a fixed dividend. Class A and Class B stock. Some companies have multiple classes of stock, with each class having different voting rights and ownership privileges. For example, Class A stock may have 10 times the voting power of Class B stock, but both classes may have equal ownership rights. Restricted stock. Restricted stock refers to shares that have restrictions placed on their transferability. This type of stock is often granted to company employees as a form of compensation and may become unrestricted after a certain period of time. Tracking stock. Tracking stock is a type of stock that tracks the performance of a specific division or subsidiary of a company, rather than the performance of the company as a whole. The type of stock that a company issues can impact the rights and potential returns of the stockholder. It is important for individuals to understand the different types of stock and their associated benefits and risks before investing in a particular company. There is no one best way to buy and sell stocks, as the approach that works best for you will depend on your individual investment goals and risk tolerance. Here are some common ways to buy and sell stocks. Online brokers. Online brokers provide a platform for individuals to buy and sell stocks, exchange-traded funds, ETFs, and other securities. This is a convenient and cost-effective option for many individual investors. Full-service brokers. Full-service brokers offer a range of services including investment advice, portfolio management, and the ability to buy and sell stocks. This option may be more suitable for individuals with a higher net worth or more complex investment needs. Direct stock purchase plans. Some companies offer direct stock purchase plans, allowing individuals to purchase company stock directly from the company, often without paying a broker's commission. Robo-advisors. Robo-advisors are online investment management services that use algorithms to manage portfolios. Some robo-advisors also offer the ability to buy and sell stocks and other securities. Regardless of the approach you choose, it is important to do your research, understand the risks involved, and seek the guidance of a financial professional if necessary. Additionally, it is recommended to diversify your investments and have a well-thought-out investment strategy. Stock options are contracts that give the holder the right, but not the obligation, to buy or sell a specific number of shares of a stock at a predetermined strike price within a specified time frame. There are two types of options: call options and put options. Call options give the holder the right to buy shares of the underlying stock at the strike price, while put options give the holder the right to sell shares at the strike price. Here's how they work. An investor buys a call option with the hope that the price of the stock will rise above the strike price. If the price of the stock does rise above the strike price, the investor can exercise the option and buy the stock at the lower, predetermined price. If the price of the stock does not rise above the strike price, the investor can let the option expire worthless. Options can be used as a form of speculation, as a way to generate income through option premiums, or as a form of risk management. However, it's important to note that options trading involves significant risks and may not be suitable for everyone. Short selling is a way to bet against the price of a stock by borrowing shares of the stock from someone else and selling them in the hope of buying them back later at a lower price. Here's how it works. Borrow shares. The first step in short selling is to borrow shares of the stock you wish to sell short. This is typically done through a broker who will arrange to borrow the shares on your behalf. Sell the stock. Once you have borrowed the shares, you sell them on the open market, hoping to buy them back later at a lower price. The proceeds from the sale are credited to your account. Buy back the stock. If the price of the stock does indeed drop, you buy back the same number of shares that you borrowed and return them to the lender. You keep the difference between the price you sold the stock for and the price you bought it back for, minus any borrowing fees and other expenses. It is important to note that short selling is a speculative and high-risk investment strategy and not suitable for everyone. If the price of the stock does not drop as you expect, you could end up losing much more than your original investment. Additionally, short selling is subject to certain rules and restrictions, and it is important to understand and follow these regulations. Long-term stock investing refers to a strategy of holding stocks for an extended period of time, typically several years or more, with the expectation of profiting from long-term growth in the value of the stocks. This approach is based on the idea that over time, the stock market has historically delivered returns that have outperformed other investments, such as bonds and cash. Here are some tips for long-term stock investing. Diversification. Diversifying your portfolio across different industries and companies helps to spread risk and can potentially lead to better returns over the long term. Patience. Long-term investing requires patience and discipline. Avoid making impulsive decisions based on short-term market fluctuations and instead focus on your long-term investment goals. Low-cost index funds. Consider investing in low-cost index funds, which provide exposure to a broad market index, such as the S&P 500. This can be a cost-effective way to gain exposure to the stock market while minimizing costs and investment management fees. Regular contributions. Consider making regular contributions to your investment portfolio, such as through a dollar-cost averaging strategy, to help reduce the impact of market volatility and potentially increase your long-term returns. Avoid timing the market. Timing the market, or trying to buy low and sell high, is a difficult and often futile task. Instead, focus on your long-term investment goals and avoid making knee-jerk reactions to market changes. It is important to remember that investing in stocks, like any investment, carries risk and that past performance is no guarantee of future results. Additionally, it is recommended to seek the guidance of a financial professional to help determine if long-term stock investing is appropriate for your individual circumstances and investment goals.